Swayam Prabha. Digital India. Educated India.
Now, I am not going to stop here, I am just going to move to the next aspect out there. This is what gives you the works cost. What are we interested in? Cost of production, works cost, gross works cost. What are we interested in? Cost of production. That is where, now look at this further, 1.3. Next, I am moving to the next level. Use the additional information in this slide to the exercise 1.2, that is this one, and calculate the cost of goods manufactured, cost of production and cost of goods manufactured. The factory holds a opening work in progress goods worth about $25,000, the closing work in process goods of about $35,000 out there. Now, let us look at opening work in process. So, what happens in this particular case? Opening work in process. What is the opening work in process in this case? 25,000. What is the closing work in process? What is the closing work in process out there? 22,000 out there is the closing work in 35,000. I am sorry. Closing work in process is about roughly about 35,000 out there. So, what are we looking at in this particular case? In this particular case out there, in this particular case, what are we looking at? Let us look at opening work in process. Let me keep a small alphabet A and let us keep a small alphabet B out here. Sir, there are two more aspects. Yes, we will come to that. Depreciation of the machine, what happens? That is a factory cost. Factory overhead out there. As I said, how much is it? 12,500. My total will change. Heating, lighting and water, again factory overhead. How much is it? 22,000. So, what is my final, what do you call it as works cost? I have to say, or cost of production slash cost of, what do you call it as in this particular case, goods manufactured. Cost of goods manufactured out there. All these three I can put out here. What is it? Your works cost gross, that is your prime cost plus your factory overhead, prime cost plus factory overhead plus opening work in process minus my closing work in process. That is all that happens out here. So, MNOP is equal to, I would say, alphabet P is equal to what do you call it as O plus A minus B out there. That is all that happens out here. So, this is what is your cost of production out there. This is what you spend for manufacturing the goods out there. This is your cost of production in this particular case out there, and cost of production is what we have seen out here in this particular case out there. Next, I am going to the, what do you call it, I am going back to the slides out there, I am going to back to the slides out here, prime cost we saw, cost of goods manufactured we saw. Next, we see what is cost of goods sold out there. Cost of goods sold, very simple thing, I found out the cost of production. I have to find out what is the cost of goods sold. Please note, there is a difference from cost of sale and cost of goods sold. When there is a cost of goods sold, I have to adjust for only one aspect, that is what we call it as the finished goods inventory, finished goods account. Because what happens, you have already manufactured some goods which are already lying in godown. You have manufactured some more goods which are going to be this year, which are going to either add to the goods that are there in the godown or not. Cost of the goods sold. For example, I may not manufacture anything, I may sell a lot of goods. So, if I do not manufacture anything, let us take the Excel sheet out here again. Let me take the Excel sheet out here. Imagine this year I am not manufacturing anything. No direct material cost incurred, no direct labor cost incurred, no expenditure incurred, no prime cost incurred, no factory overhead incurred. No cost of no work in process, because last year I finished everything out there. No work in process also incurred. Do you mean to say there will be no cost of, what do you call it, as cost of goods sold? There will be, because you are already incurred in the last year, and those goods are lying as finished goods inventory. So, those finished goods inventory is the cost of the goods that are sold. If you are selling those finished goods which you have manufactured last year, so there is a cost associated with it, and that is the cost of the goods sold, not produced. Produced production is over. What is the cost of the goods sold? Cost of the goods sold is what you are selling. What is it you are selling? I have not manufactured anything. I am selling the goods that are already there in my godown, that are manufactured last year. So, what is the cost of sale? Cost of sale is the value of the goods that is there already as a finished goods in the godown out there. Now, I manufacture a lot of things. I do not sell anything this year. This year is COVID, bloody damn, I am not able to sell anything. So, what is my cost of goods sold? Zero, because all this cost is going to go and sit back as my finished goods inventory in my godown out there. So, what do you have to do? You have to adjust for finished goods inventory to arrive at what is called as the cost of goods sold, and that is what we will do now out here in this particular case out there. So, let me take up the next number out here in this exercise, what I have given out here in this exercise. The next number is very clear here. In class exercise 3.1.3, that is what we did, whatever we did. The factory holds an opening inventory of finished goods worth about $95,000 or 95,000 rupees. Cost of goods sold and cost of sale. We are not worried about cost of sale. We will worry only about cost of goods sold now. We will come to cost of sale in a few minutes from now. We will come to cost of sale in a few minutes from now. We will worry about only cost of goods sold. I will say cost of goods sold. Let me write it in caps. Let me say cost of goods sold out. So, the factory had an opening inventory of about $95,000. That is, now there is a opening inventory of finished goods. I am sorry, everything is in caps. Goods. How much is it? Let me term it as alphabet C, small c out there. It is about 95,000 rupees out there. Then I had a closing inventory of finished goods. Now, let me term it as alphabet D, and the closing inventory of finished goods is 45,000. So, what is Q? Q is equal to what is called as P plus C minus D out there, that is all. So, what happens? My cost of goods sold is the cost of goods manufactured plus whatever is the opening stock of finished goods, cost of that, minus whatever is the cost, stock of finished goods that I am keeping back in the godown, is what is called as my cost of goods sold. In this particular case out there is what we call it as the cost of goods sold in this particular case out there. So, what is the cost of goods sold? We have got the cost of goods sold 232,300 is the cost of goods sold. Sir, there are a lot of other things. We will come to other things out there in a few minutes. So, what happened? What did we do? I am summarizing out there. We took all the direct material, direct costs involved. We found out what is the prime cost. We added all the factory overhead out there, adjusted for work in process inventory, we got what is called as the works cost, or the cost of the goods produced, or the cost of goods manufactured, or cost of production, whatever you may call it. We adjusted for the finished goods inventory, we got what is called as the cost of goods sold as of now. Now, what next? We have to find cost of sale. We will find cost of sale in a few minutes from now. Don't worry, we will find cost of sale. We will go back here and we will find cost of sale out there. Now, cost of goods sold, of course, I am going to give you manufactured product cost, all these examples out there. You can look at these examples by yourself out here. Raw material, what is the manufacturing cost, product cost, work in process, finished goods, completed units, not sold to the customers, etc. Definition of all this is the same slide, unfortunately got included twice, I think. So, what happened in this particular case, after your cost of goods sold, I am just given some explanations out there. Then I have what is called as the other cost normally out there. That is what we could look at cost of classifications when we prepare out there. There is something called product cost, there is something called period cost out there. Now we come to non-manufacturing costs, that is what we call it as the selling and administrative costs out here. That is what I have highlighted in this particular case, selling and admin cost. They are all called as, what do you call it as, period cost out there. Whereas product cost is involved directly with the product, the direct material, the direct labor, direct expenditure, manufacturing overhead, they are all product costs, they are all costs associated with the product. Whereas period cost, why do we say period cost is, we will say these costs are basically time bound, not related to production activity. These costs could be time bound. My administrative, I pay salary to my office staff, time bound, most of these. I pay what is called as selling, I pay some commissions, whatever it is, time bound, etc., salaries to my sales staff and so on and so forth. So, they are all called as period cost out there. My product cost will affect the inventory in the balance sheet as well as the cost of goods sold in income statement, whereas my period cost will affect only the expenditure in my income statement out there. Please note the difference between period and product and period cost out there. Next, I have a whole lot of non-manufacturing costs. These period costs are all non-manufacturing costs, administrative cost, all executive, organization, clerical, whatever it can be. Selling costs can be direct, can be indirect, etc., etc., etc. Selling direct cost out there, commissions, etc., etc. out there. Not manufacturing, direct selling commission in this particular case, variable, yes. So, they are all called as non-manufacturing. Moment I add these non-manufacturing costs to the cost of goods produced or cost of goods manufactured, the resultant figure is what we get it as cost of sales. The resultant figure what we get is cost of sale out there. That is what we will take out here. That is what is the cost of sale. Cost of sale is computed taking the cost of goods sold but after a value derived from the finished goods account, that is after considering the finished goods account out here. You add the selling distribution overhead, you add the office and administrative overhead, what you get is the cost of sale out there. What you get is basically the cost of sale. Let me go back to this own example out here. I am just going to divide the screen out here. Oh, I am sorry. Keep it. I am just going to divide this out here. 1.3 is over, 1.4 out here. This is where we were. What did we do? We look at the non-manufacturing overhead out here. I am looking at what is called as the non-manufacturing. I am looking at what is called as in this particular case. I am looking at the I'm going to look at what is called as the administrative overhead out there. Overhead, R is missed out. I am looking at selling and distribution overhead. Sales commission to sales managers, yes, sales commission to sales managers and sales manager's salary. Sales commission and sales manager's salary roughly about 85,500 in this case. Office building heating and lighting insurance, office building heating, lighting and insurance. It's a part of the administrative overhead out there, it is part of the administrative overhead out there, it is part of the administrative overhead in this particular case. So, I am just writing it here and that is about 37,000. Sales promotion and advertising, selling expenditure, sales promotion and advertising. Sales promotion and advertising, what happens? It is about 22,000 out there. Now, let me look at what is the total of the administrative expenditure in this particular case. The total of the administrative expenditure is only so much. So, I will say PQR and then my total of me selling distribution expenditure is these two put together out here in this particular case, that is PQRS out here. Next I will say what do you mean? I will say what is the total non-manufacturing expenditure. Non-manufacturing expenditure if QRST is equal to or plus yes out there, that is this is what is expenditure which I incur for not manufacturing. Non-manufacturing expenditure is so much 1,44,500. 1,44,000. Now let us look at what is called as the cost of sale. What is the cost of sale? Cost of sale is the non-manufacturing expenditure plus my what is called as the cost of goods sold out there. So STU that is equal to my T plus Q out there, T plus Q, and that is what it is, T plus Q out there. So what is my cost of sale? My cost of sale is after including all this, after including the non-manufacturing. Sir, why are you classifying all these things into so much? Why are you making life complicated? Don't worry, we will come back to it. We will come back to it in just a couple of minutes from now out here. We talked about cost of sale, fine. After that is the exercise out here. Now the next stage, what I am going to do out here is I will say I have built one more. Continuing from that exercise, that is exercise 1, it is not 5, it is 1.5 out there. Find out the profit or loss out there. That is, I will say the gross sales amounted to 3,82,760. Some of the goods that were sold were returned by customers amounting to so much out there. Let us take that out here in this particular case out there. What is the basically what is the value of the sale out there? Sales gross. Sales gross is how much? Sales gross in this particular case is about 3,82,760. Next I say less sales return. Less sales return is what is it? 10,400 out there. So what is my net sales? My net sales in this particular case is what is called as net sales. Net sales in this particular case is 3,72,000. So I would say term it as UV and then I would say W and I will say WEX is equal to V minus W out there. Now what is it? Net sales is so much. Net sales. Let me even take this out there into the sorry, I'm going to even take this out here into the next row so that let me get this a little bit, let me get this highlighted in the process out there. Let me get this highlighted in the process out there. I'm just going to say, I'm just going to write this up here, net sales out there. Net sales out there is equal to X is equal to V minus W out there, and that's going to be is V is this minus the W is the return out there, and there's going to be here. I'm just going to erase this off. Why am I doing it? No problem, wait. Now what happens? I want to know profit or loss. Less cost of goods sold. Cost of sale, I'm sorry, cost of sale out there. Cost of sale, we got U out there as cost of sale out there. Cost of sale is U out there. That will give me cost of sale is U. What is the cost of sale? Cost of sale is given here in this particular case. That is going to give me the profit or loss out there in this particular case, and that Y is equal to what do you call it as X minus U out there, and this is what we will term it as profit slash loss out there. So we got a profit or loss out here. We have come to the end of the slide, that's not a problem. Now I am just going to suppress the slide out here and then move the Excel out here. Sir, what is the purpose of all this? Now what is the purpose of all this? Don't worry, I'm just going to reduce the what do you call it as delete these things so that it becomes a little more easier for you to see, move it up and down out there. What is the purpose of all this? Now let us see, this entity has made a loss. Now I have to do what is called, yesterday I talked about cost control. Now where is it that I have to control? Let me see what is the kind of expenditure. Let us say that, let us look at this profit, let us look at what is the net sales figure, that is E55 in this particular case out there. Now let me see what is the direct material cost that is basically consumed out there in the case of here, what is the percentage out there, E55, I want to express it in the form of a percentage, 4.3% out there of my sale value is pertaining to material. Same thing, let me do it for my labor, E55 if I am not wrong, that is what I talked about, E55, yeah, E55. I see that 13.43% of my expenditure of the sale value is going towards labor cost. Now I will know where I am going to control out there. Now let us look at the overhead expenditure. Now same thing, I am going to do E55 out there. 1.2% is basically my direct expenditure, and then let us look at what you call it, your prime cost. Your prime cost is about 18.93% is your prime cost out there of the sale value. Now can I do this for everything? Yes, I can do it. I can do it item wise. I can do it overall. Now let me see my factory overhead out there. My factory overhead is about 32.71% is my factory overhead. What is my works cost in this particular case? Let me see that. Yes, works cost also. Let me look at my works cost out there. Now let me look at my works cost out there. My works cost is 48%. Our cost of goods manufactured is 48.96% out there. Now let me again, what is my cost of goods sold? My cost of goods sold in this particular case, again I can see that it comes to, my cost of goods sold is 62.39%. What is my admin overhead per se? Single admin overhead, I can see that my admin overhead itself is about 9.94%. My selling and distribution overhead is about, what do you call it, as about 28.87% significant. I can even look at my non-manufacturing overhead out there is about, what do you call it, as about 38.81% out there. So what is my cost of sale? Obviously my cost of sale is going to be higher than that. I can just do it and everything calculate. So what does this give you? This give you where, how much money is being spent on the sales value. Now I will know where to control. For example, I would say, sir, can I reduce the work in process? If I reduce the work in process inventory, then will this cost not come down? Yes, for example, instead of 25,000, you make it 2,500 and you make this 3,500 out there. Now you see the work in process, basically the cost increases out. Now can I sort of do this? Now can I do this in this particular case out there? Can I sort of alter the work in process? Can I eliminate the opening work in process? Does it come down? Yes, no, out there you can basically see that out there it comes down. Now can I basically use some kind of a mechanism to control? For an example, finished goods, my finished goods instead of opening inventory of 95,000, if I bring it down to 25,000, will my basically, what do you call it, as my cost of goods sold, will it not come down? Yes, you see it has come down out there. So whatever that finished goods, if you, that inventory you're holding out there, that means what? You're not having too much in stock, you're selling all the goods out there. That is the message what you're trying to convey out there in this particular case out there. So what are we looking at out here? We are looking at, for example, my labor cost is about 13.43%. Can I control the labor cost here so that my cost gets controlled? I see my, what do you call it, as my selling and distribution cost out here in this particular case, somewhere I calculated in this particular case out there. I am just going to go back and recalculate out here in this particular case. That is what I missed out, E55, and then what do you call it as this by E55, and then I have this by E55. Now I see that my non-manufacturing itself is about 38.81%. That is, my selling expenditure is about 28.87. Can I control the selling and distribution expenditure? I am not getting that kind of a return out there because I am making a loss. So yes, I can do it. Maybe I should monitor these two expenditures out there. So basically this gives you some room for cost control. This is what we call it as the cost sheet. So same profit or loss account I have prepared in a different format out there and nothing beyond that. All that this gives me is, this gives me some room. I will know where how much I am spending. That gives me room for cost control out there in this particular case out there. This gives me room for cost control. Now what is that administrative overheads? I am just taking another sheet of the same example. It can be administrative overheads, can be many of the things. It can have depreciation, it can have office salaries, it can have rent rates and taxes, it can have sales promotion, it can have distribution salary, it can have depreciation of the building, the share of them, and so on. All those kind of expenditures can basically come in. I have just given a format out there. I'll load this Excel sheet out. So what does the Excel cost sheet tell you? Cost sheet tells you the distribution of the cost, the classification of the cost out there into prime, works, factory, administrative, selling, that is non-manufacturing and everything. So we know how much you are spending. We know your inventory positions out there. We know whether because of inventory you are getting into trouble, whatever, everything out there. So you can adapt a cost control mechanisms from here on. Okay. Just go through this. We meet again. Thank you.